designs on buying your dream home in retirement? Well, here to talk with me about that is Dana Anspach from Sensible Money. Dana, welcome.
Thank you.
Good to have you here. A lot of clients that you have and a lot of people around the country often think about buying their dream home in retirement. What advice do you have for folks?
Well, my advice is do the numbers. You really want to make sure the house is affordable before you go forward. It's interesting. I've been thinking about why is it that people wait till retirement to buy their dream home or build their dream home? And in some cases, I think that's when they have time. There's that sense that I made it and now I can go, enjoy this space. I want my dream home now. Whereas when I was working, I wasn't at home that much anyway. So what was the point? And we've seen successful situations where people built their dream home and it worked out well. We've seen situations where if they were building from scratch, it cost twice as much and took twice as long as they expected and put a severe dent in their nest egg that they hadn't counted on. And so those are some of the things that you really have to watch out for.
How do you determine if something's affordable?
That's a great question. We do a lot of testing. So you hear about stress testing for the banks to see if certain things in the economy would impact their solvency. And I think of it the same way. A pension plan will send out an annual notice of its level of fundedness. So it's a form of testing to make sure the pension plan can fulfill its obligations. Well, in retirement, you have a set of obligations, your future expenses that your portfolio needs to fulfill. You're going to have income coming in from perhaps Social Security, pensions, maybe an annuity, maybe rental income, maybe a deferred comp plan, but you're also going to need withdrawals from your portfolio. So you have to calculate out what those liabilities are. And if you're going to have some big cash outflows to move, or you're going to take on a bigger mortgage, we just did an analysis for a client looking to buy about a $7.5 million dream home on the coast in Florida. And it was a lot of modeling and stress testing and deeper questions such as, do you want this lifestyle for a temporary period of time? Or is this the home you want to live in the rest of your life? Now, in this client's case, the answer was temporary. So if you're going to own this home for a 10-year period of time, well, let's think about some of the risks. A hurricane could wipe it out. What if the house is outdated by the time you go to sell it? And it's going to cost a lot to remodel it before you can sell it. Now, there was a lot of research done on properties in that area and ones that had sold even being outdated and things like that to so that the client felt comfortable and research they did on their own because it's a big decision. And so they wanted to feel comfortable that this was not going to ruin their retirement. So when we talk about how do you determine if it's affordable, well, those are some of the things that we're thinking about. If it's going to be a temporary lifestyle and you're assuming that that house sells 10 years in the future, well, what growth rate are you using on the property? We typically use 2%. We'll have some people say, well, in my area, that's too conservative. Well, we don't want to be too aggressive in our assumptions in retirement, because what if we get 10 years out and the real estate market's in a slump, right? And you were counting on that money and it needs to be a window of time. So we might stress test and say, well, you can live in a house like this for 10 years or 15 years, but sometime between 80 and 85, you will need to look at downsizing or exiting out. There's other cases where affordability was based on the rest of my life, right? I want to build this house and I want to be able to live there the rest of my life. Sometimes that involves trade-offs. Okay, you can do that, but you will be intentionally spending down your financial portfolio assets. Meanwhile, this real estate asset will be growing. And if that's okay with you and that's an acceptable trade-off, then yes, the house is affordable. I have others, a client that was just in this week who absolutely doesn't want to spend principal. And so that thought of spending down their financial assets to afford something would terrify them. So we're all different. And so affordability is not only running the numbers, but it's also taking into account your own comfort level. And you want to be able to sleep at night in retirement.
When I think about affordability too, it's the notion of you may have some people that want their dream home, but also maintain their whatever their principal residence and have two residences?
I've definitely seen that. I had one of those recently where we said, well, you can buy the dream home, but you can't buy it and maintain your residence. So you're going to have to decide what's most important to you. Now, you could have a property in both locations that were smaller and, less maintenance cost, or you could decide to sell the property in the, cold environment up north and only live in the property in the south. And so that was a decision that they had to make and decide, well, which was most important. I have another a client here locally in Arizona, where I am, who wanted to see if they could have a property, here in the Phoenix area and one in Flagstaff, only about a 2-hour drive. And they could, two smaller condos, and be able to go back and forth. And likely, as this person enters into their 80s, they will downsize out of one of them. But when we ran the numbers, we wanted to make sure that was never required. So it wouldn't be, well, in 10 years, you will no longer be able to go back and forth.
You mentioned financing and debt. Do you find that people are having to get a mortgage or buying properties outright with cash, or what? How are they financing their dream home?
Well, it has so many things. It depends. You and I see a lot of stats that says, one of the signs of a happy retiree is someone who has their mortgage paid off. And generally, I agree with that, specifically for people that have a net worth less than $1 million. However, smart debt isn't the worst thing in the world. And sometimes to make a transition between properties, you need debt. One of the things we will recommend is that people might take out a mortgage on the new property. And then when the old property sells, they do something called a mortgage recast. You and I did a video on that recently. It might be that you take a home equity line of credit out on your current property, and you're using those funds to either, get the property ready for sale, or, technically you're probably not supposed to use those funds to put down on the new property, but oftentimes people do. And then you're going to pay it off when your previous property sells. Sometimes carrying a mortgage in retirement at a small amount is perfectly okay. There's other, ways you could finance it. I've seen people borrow out of whole life policies. I've seen people borrow out of what are called pledged asset lines of credit against their portfolio. You cannot borrow against IRA or retirement assets. But if it's affordable in the long run, right? If you've done all your stress testing in the long run, and then you're simply figuring out how to try to finance this move basically over a 12-month period of time, there's nothing wrong with debt for those transition periods.
Do you have any thoughts about whether someone should apply for a mortgage if they need one before they retire or after?
It's a great question. It's easier when you have W-2 income. And so if you are thinking about this dream home, yes, maybe it will be easier if you do that and apply, get approved, and get all your financing in order before you retire. However, if it's affordable to you and we've done all the stress testing, you should still be able to get the mortgage once you're retired. If you can't, then maybe it wasn't affordable in the first place. It's just a different process. So once you're retired, most of the time your mortgage broker, if you're working with someone who works with retirees and you want them to have that experience, they can tell you specifically what they need to see. We need to see $10,000 a month being deposited from your IRA, to your checking account. And they might only need to see 2 months of those deposits. You might say, well, I wasn't planning on using my IRA yet. Well, it's just to get you qualified. You might have money in a brokerage account, but for the rules of underwriting, they won't allow withdrawals from that brokerage account sometimes to count as income. And so they may need to see specific deposits coming out of a retirement account, but there's definitely ways to get you qualified. And if you ended up taking, 2 months worth of distributions from a retirement account that you weren't planning on, but that's what allowed you to qualify, that's okay. It's okay to do things like that. You just have to be prepared. I do see a lot of people who haven't applied for a mortgage recently, and they are a bit shocked by the underwriting standards, and they might get angry. Why are they asking me all these questions and asking me for all these documents? And that is just the way it is now. You have to be prepared to be grilled about your finances.
So, speaking of preparation, there are a lot of risks that people need to contemplate as well.
There are risks. I have a planner that works here, and she worked at a firm that worked with very high net worth clients before joining us. And she was telling us the story of a client that bought a $15 million property in Florida and decided not to insure it because it was going to cost so much. As an example, the case we were just working on, the coastal property, the $7.5 million property, it was going to cost over $100,000 a year between property taxes and homeowners insurance. And so that's that's a big outflow to test. It's not just buying the property, it's affording the property. Well, in this story, our planner was telling us the client said, oh, I have plenty of assets. The insurance is too much. I'm not going to insure it. Hurricane came, wiped out the property. Now, the family did have plenty of assets, but still, you're just throwing away $15 million. They also had plenty of assets to cover the insurance. I was just reading a story in the Wall Street Journal this morning about a coastal property where the day before they were supposed to get their certificate of occupancy, erosion kicked in and it essentially wiped out most of the backyard and kind of the foundation under the pool. And so I believe the article said they were self-insured. That's a big risk right there. If you can't afford to insure the house, my thoughts are you can't afford the house. And so, that needs to be part of that modeling process. Even if you have insurance, it's still going to cost a lot of money if a natural disaster comes. If you live in a fire prone area in California, you have to think about that. If you live in a hurricane prone area on the coast, those are things to think about. Those are real risks that you have to be prepared to face if they happen. The other is simply more expensive properties have bigger problems. So, whether it be a foundation issue or maybe the roof needs to be repaired or a plumbing issue, you need to be prepared. And that should be part of your financial modeling process is that, wow, if I'm looking at a much more expensive property, I need to be prepared that I could have bigger problems, bigger outflows for home upkeep and repairs.
So one other question that's triggered when I think about buying your dream home and maybe relocating is all the ancillary costs that you may or may not be factoring in. So does that state have an estate tax? Will you be subject to personal income taxes? Will your IRA distributions be non-taxed, et cetera, et cetera? There's a lot of other financial factors that need to be sort of weighed when you think about your dream home and the location where you may be moving to.
There are, most often it seems like we're looking at people moving to Florida or Texas. And so they're actually reducing their state taxes in that case. But yes, if you are moving states, I had a client who was looking on the border of Wyoming, I believe, or Idaho and trying to figure out, okay, would it make more sense to build the house here or here? And in the end, where they really wanted to be was Idaho. I believe the taxes would have been less if they had been on the Wyoming border. They were on a town that was right on the border. And so, the taxes would have been a little less, but it wasn't enough to weight the difference. They found the lot they wanted and, it happened to be on the Idaho side of the border. So those are definitely considerations. If you're talking about a state with a lot of high state taxes, those are big considerations, right? If you want to move to California, state taxes have to be factored in. If you're not talking about a big difference, then hopefully you get to make the decision. I mean, it's supposed to be your dream home. And so hopefully it's not completely predicated on, my Social Security won't be taxed if I do it in this state versus this one.
The other thing about dream homes too is people often get advice about where to buy your dream home and whether it should be close to family or close to friends or not. Do you have any thoughts about like people sort of moving to dream homes where they need to be close to family or not?
That's where I like to think of retirement in phases. So there's many retirees who will retire overseas and they want to be expats. Panama is a big location and they might decide, wow, I can live here and have all kinds of ancillary services like a cook or chef and a cleaner and for a very low cost. And they might do that for, 10 or 15 years with the intention that they will come back to the US and be close to family later in retirement. I also, have a story of a client who originally retired. He was part of a medical practice and owned it was a co-owner in the commercial building that the practice operated out of, and also had a property on the coast in California and one in Arizona. And so, the plan had been, well, during this window of time, you'll have to exit out of the commercial property interest. And then at some period of time in your 80s, you'll have to exit out of either the Arizona or the California house, whichever one. Well, ended up things happened exactly as we planned and not exactly as we planned, meaning everything happened, but never in the exact year or the exact amount that we had projected it would happen. They did end up getting bought out by the partners for the commercial property, and then they decided to move to Denver and exited out of the California property. And then as they got into their late 80s, exited out of the Arizona property. And the reason they chose Denver was later in retirement to be closer to one or two of their adult children. And so, but it was a phase, right? They had a phase where they went back and forth between California and Arizona in early retirement, and that worked well. It was a wonderful phase. And then they reached that point where they said, we really should be closer to family. And so now we're going to choose a different location.
So it sounds like the message there is to be fluid in your thinking around planning.
You do need to be fluid. So many people, they want to pay off their car before retirement and, get everything, quote, done, right? I'm going to retire and that's going to be it. And I rarely see it work that way. All kinds of new possibilities open up. You have more time in retirement. You might develop new hobbies and interests that mean you want to live somewhere else. Your family dynamics may change. And so you want to be open to those possibilities and be flexible, as you said. Absolutely. I think flexibility is key.
All right. So we could go on dreaming for a bit here, but anything we missed or bears repeating?
I think if there's anything, I feel like people have trouble thinking about these possibilities if they don't even know if it's affordable. And so while I love the idea of being flexible and going through all of this, so many people are afraid of financial planning because they're afraid of hearing that no. But sometimes what they hear is a yes, you could do this. And so it can open up possibilities. I've had people look at the numbers and evaluate things and decide not to proceed. But they're not wondering in their mind anymore, right? The financial, knowing what was possible financially freed them up to look inside and decide what was really important and then make a decision based on that.